Hello everyone, a very good morning, good afternoon and good evening to all. Myself Vaibhav. In today's session of automated trading, we are going to mostly finish with this Williams and historical candles combination. This is the fourth part of the ongoing series and most probably the last one as well. So I hope by now you are well familiar with the functionality of the Williams R and the ATR. So straight away we go into this standard disclaimer. Here I would like to remind you that this is simply a tutorial session and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would suggest that you do extensive trial runs and also allow it to run for sufficient enough time on the demo accounts to get a clear idea of the efficiency of the algorithms. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. On that note, we get back to the business. Here I would like to give you a brief summary of what the idea is all about. So we are looking for the overbought and oversold conditions for the trading. So when the Williams R has been in overbought territory for at least a day, we will be looking for a sell trade, and inversely, for the buy trade, it should have been in a oversold territory for at least a day. Then immediately, the just prior to the execution of the trade, we want the last 4 hourly candle to have closed in green, and 4 candles prior to the last candle should have closed in red with the losses amounting to more than 100% of the ATR. So it should have nosedived more than the whole day's range, and then there should be some buying momentum in the last candle. And in case of sell, the conditions are going to be reversed. We will want the candles to have been in green, and then the last candle should be showing some selling pressure. So that is the whole idea is about. So we straight away go to the setup which we have developed so far. This is a standard instrument subscription. The position amount has been defined at 0. Then we got these Williams R candles blocks, shift 1, shift 6. Then we got these 5 historical candles, shift 1 to shift 5, to see how the candles have closed prior to the trade execution. Then we got the ATR. The ATR has been defined at shift 1, means it will be taking the yesterday's value. And then we are looking at the distance between the candle open and the candle close. So here we will be comparing the candle with the shift 2 with the candle with the shift 5, and we will make sure that the distance between that is more than the ATR. So we will be comparing these results, this buy candle difference and the sell candle difference, and then we will compare these results with the ATR range. And only if the difference between the closing and the opening is more than the ATR range, we will go for the order execution. Then for the execution purpose, we got these 2 historical candles of the 10 seconds. So these are just for the execution purpose. We will be checking on the value, the buy execution price and the sell execution price, and when the price starts to rise or fall below those levels, we will go in for a trade. So that is the whole idea. And then we define the stop loss price and the target price using the dynamic setup. So we are depending on the ATR for us to help us determine the optimum stop loss and the target level. So we are going for a 30% of the ATR as our stop loss and the 75% of the ATR as our target price. So we are basically looking at a risk reward ratio of 2.5 here. Then there is the level, the sale execution price on which the selling would happen. Then we develop this buy side. All we have done is that we look for the candle open and the candle closing levels, and then we have defined the conditions as we wanted. Then the Williams R should have been in oversold territory for the buy trade. Here we got this candle difference compared to the ATR. Then as I said, we are simply looking at these 10-second candles for the momentum to start rising above our defined levels, and then we will go in for a fresh execution. So that is the whole idea. And on the sales side, what we have done so far, we have determined these overbought conditions. So here we have defined this condition that Williams are for the shift 1 as well as shift 6, that is the last candle's value and the dayback's value should have been in overbought territory. So that's it. And then we have checked so far these candle closing for 17, 18 and 19. Now we have two historical candles left, so we check those opening and closing levels, and then we would continue with our algorithm setup. So here we will compare these values and try to see. We will need now the candle 20's opening and the closing levels. So we go for the last candle. No, we need auto created variables. 17, 18 and 19 we have done, so we go in for 20 and the 21st. So this is shift 4 and the shift 5. And for a sale trade, we would need the candle 20 to have closed in green. Let us go back to the sell side once again. We have looked for the candle 17s and the 18s. So here 18 and 19s closing levels should be higher than the opening levels, and for the candle 17, that is the last candle, the closing level should be less than the opening level. Now getting to the candle 20s, so here we take candle 20s close and candle 20s open. We take in another E block. We are going to need couple of them now. So okay. So here we need the candle closing to have been higher than the candle opening level, and same thing for the candle 21st as well. So we go and check the candle's closing level and the candle open, and now we have defined this condition as well. Candle closing should be greater than the candle open. Now we have to see if the difference between the closing level of the candle with shift 2 and shift 5 is greater than the ATR range. So we take this candle's 18's closing level and the candle 21's open level, and we have done this calculation here. So we take this difference and then we compare it to the ATR, and the ATR is here. We need it to be greater, the candle difference should be greater than the ATR range, it will mean that even after being in overbought conditions, on top of that we have got expensive run on the high side as well. Now all that needs to be done is to look for the last 10 seconds candle, and we are almost done with the prior setup, and that should be that would also be good enough. Then we will proceed for making it more dynamic in case of the lot size, and even you can utilize even without making further changes as well. So I will show you the first version before we go on to make some modifications for the second version. So here we would look for the candle 36 and the candle 35 closing levels. So we look for candle 36 closing, candle close, and we take the sale execution price, that is candle 17 closing level, plus 10% of the ATR. So here it is, and then we go for the candle 35 close. Okay, so we now go in for the candle 35 closing levels, and we need it to connect the dot. Candle 36 closing should have been greater than the sale execution price, and then the candle 35 close should be less than the sale execution price. That means that the price of the underlying instrument is starting to fall below our execution level, and now it's time to go in for a fresh trade. So we go in for a market open at market. Now this is the setup, which is pretty good in itself, and we now take this and join the dots. So we got this, and here we connect. Okay, so far so good. Now I think we should also do one trial run before we go for some changes. So let us try to do some test run as well. So here we arrange this bit of aesthetically. It should be looking neat and tidy. That's the reason. Okay, and then we proceed for bit of trial run before we do some changes for further optimization, and I would explain to you what we intend to achieve by those changes. Now here we need to define the stop loss and the target levels. So here instrument is right, this is the sell side, and we want the trading amount to be placed at 0.1 million. All right, slippage should be 2 pips, so it is 2 pips, and then we got stop loss and take profit. Now sale execution price is our stop loss and TPP is our target. So that's it, that's good. We save the file and we proceed for the first trial run. And since this algorithm is based on 4-hourly charts, we can expect that the trial run would be fast enough and give us idea if our algorithm is working desiredly or not. Let us save it first. Save the draft with the name of APR 9. April 9 is the date when we started developing it. Now it's 16th of April because there was long Easter weekend, so it's looking more kind of more than a week now. So we expect the file in Java. Good. And here we go. We have our treasure trove of the algorithm saved here, developed in this month. So APR 9 is going to be saved, and we export that, import that same file in this demo count. This is a demo count. I have kept some of my personal algorithms running here for the trial run, and we now look for our file which we just saved. So we go to the same folder and we pick up that file, and here we are. This is the PR9. So we got the file. This is the code in Java. So those of you who are well familiar with the Java would be able to utilize this source code as well and make some changes if the need be. We need to first compile it. Let us see if the compilation is successful. Okay, compilation successful. So we immediately decide to do the test run, and what we do, let's put it for last month straight away. I don't think the test run is going to be fast enough for allow us to do it for a month, so we are not really looking at doing it for a month, but let's give it a try. Or we would look at the chart where our condition might have been fulfilled, and then we simply go back and see if not the custom. Okay, let's take previous month. It will start on 1st of March, and we go for the test run. Here we don't need to be bothered with the take profit and stop loss, as we have kept it dynamic. We simply make some basic changes here, and then we allow it to run as it is. Run, boy, run. And let's see how much time it will take. It shouldn't be taking too much time. Okay, so here we go. This is fairly good, not that slow, but still I don't think we are able to cover the whole month's test run. So let us again go back on chart while the test run is happening here. want to know if any trading happens. Now we look for the chart, on the chart where our algorithm would have traded as per the defined conditions, and then we do the test on that time frame to see if it would have indeed executed the order as we desire it to, and how it would manage the position. So far, I think here this one time the conditions are looking like that they might have been fulfilled. So we would run the test around 19th of March, and this is also 9th of March. So we have these two instances where it is indeed looking like that the conditions might have been fulfilled. So we can going for some custom. Okay, we got so far 6th March is here. Just let us wait few minutes, and 9th of March will be covered pretty soon. Thank God the test run is not that slow, so we are able to cover a lot of ground in less time. So far, 9th of March, we are not really seeing any execution of the trade. So, as we can see, I don't think the conditions might have been fulfilled, but on the chart here it was looking like that maybe we might have got a trade there, but that's not really the case. And now we will again need to wait till 19th of March, so we can do one thing. We stop the page down and then we start straight away on the 19th of March rather than waiting so long, or we can give it a couple of minutes. So far trading has been done, and now we can do nothing. We can even I can try to explain you what the changes which we are planning to do. So I would need to take in the ATR range. For that we need to look for the ATR, and then we will need the daily time frame chart. Okay, so we got the daily chart. Now I'll explain to you what I'm actually trying to achieve. So here you can see that ATR stands elevated. Let me increase the zoom so that the ATR value is clearly visible to you. So here, as you can see, yesterday's ATR is around 123 pips. Prior to that, it was even above 150 pips. On 26th of March, it was almost 160 pips. Then we go back in time, around 10th of March, it was around 100 pips. Then we go back in time, around 23 or 23rd of February, it was around 50 pips. So what happens in any instrument in different times and because of different conditions, the market volatility keeps increasing or decreasing. So what we need we want the trading lot size to adjust accordingly. Suppose the volatility is lot less, then maybe we can take more risk with less amount of target price and stop loss, as the losses would be contained because of the short trading range. And if the volatility is higher, then of course our stop loss and the target price would be a bit wide, because we are going in for a dynamic setup. So at such moments we need to reduce our lot size. So for that, depending on the ATR range, we can adjust the lot size. For that, we will need multiple market open. First, we will need to check in for the ATR conditions, and then depending on how much volatility is there in the underlying instrument, suppose it is 50 pips, then maybe the lot size can be higher, say 0.3 million. If it is 100 pips, then the lot size can be of 0.2 million, and if the ATR is 150 pips, then the lot size can be of 0.1 million. So that's the basic idea. Suppose if the volatility rises, then our lot size gets reduced, and if the volatility comes down, our lot size increases. So on balance, it will keep the risk kind of on the even footing, not exactly on the even footing, as it won't be making changes with every change in the ATR pips. We are going just for intervals, and we will change once that interval is reached. So it's not exactly dynamic. Still, we can give it a try, and I think it should work well. So that is one thing which we can try. Now our algorithm test run has reached almost 19th of March, so we will wait it for. And I don't think in today's session we won't be able to do the changes. So what we will do, we will make those changes in tomorrow's session, and we will see what happens on the 19th of March, if there is any possibility of algorithm executing the trade. So one change which will make our algorithm more dynamic, and it will keep adapting to the situation as the need arises. So that's the whole idea. Now, as we are approaching the 19th of year, let's see how it goes. Liquidity is at the starting level only. No trade happened so far. So the profit loss, and the 19th of March has passed, but we are not seeing any trade. So with that, we will now need to wrap the session. And suppose if you like the idea, I would recommend that you do in trial runs, maybe a year or even more than that, and then see in longer time frame how it does, when the trading will happen and when it will not. Because on the chart, on the naked eye, by the naked eye, we see different things, and then when the system is doing the same thing, it will see a bit different, pay more attention to the details. So we will be a bit safe if our trading is done by a sophisticated system. So that's it from my side for today's session. If you any video need to share, you can write in the comment section, and I'll be happy to take this session forward. So tomorrow, if you want to see the optimization, or if you feel you have got the idea, we can even straight away proceed for the next setup, or we can do that optimization of the ATR range as well. So both of the options are open. It's not a difficult thing to do. We just have to check for the ATR values and then make necessary changes according to the underlying instruments market volatility. So that's it. Have excellent time ahead. See you tomorrow. Goodbye.